Good afternoon. So I'm going to focus my questions on ring fencing and culture and governance. But before I do that, I just wanted to ask a follow-up question about Solvency II and Sam Woods' response, in fact, to a question I asked when he was here. I raised the question about whether it poses a risk to financial stability, and he switched to policyholders, which we've touched on. And he said, I think it's much more of a policyholder protection issue, because ultimately what will happen here, if it turns out that this was a problem, as I say, people can debate either side of it, that should have been addressed at this point, rather than at some point later or not at all. Then the way it comes home to roost is if there is not enough capital backing pensions. And now you can look at history to give you a guide as to what is likely to happen if that occurs. And I would say it is highly likely that comes back to the public purse if that occurs, etc. So, having seen these issues in terms of banking crisis and responding, do you think that the government should step in and make sure that the risks to policyholders is addressed now, so that we don't belatedly find that we've got to resolve these issues later and policyholders suffer?
I think that it's really important to draw a distinction between the overall level of capital that's held for solvency reasons and the way in which that capital is deployed and built up. So my understanding is that the PRA is always able, within that Solvency II regime, to make the appropriate adjustments to make sure that the aggregate level of capital is held. My issue is actually about the way in which some of that capital is deployed, and if it's concentrated in particular assets, and those assets, for the want of a better word, are overvalued through crowding created by the regulatory incentive, the point at which that unwinds, the loss is ultimately to the policyholder. So, yes, so I think it's quite important to look at the makeup of the capital.
Okay, so if we want to avoid losses on policyholders, which we as representatives want to avoid, what should happen at this stage to make sure that we preemptively take steps to ensure that our constituents don't end up making losses as policyholders? Because it can't be right that that's where we're heading.
Well, I think that when you look at the way in which the capital is deployed, technically you need to take account of appropriate diversification levels to make sure that the balance sheet is diversified in a particular way and risk is not concentrated. So I think quite a lot of this is in the detail. If you can't do that and concentration increases, then there's the ability to actually increase the overall level of capital. And my understanding is, with some recent reforms that were looked at being put in place post Brexit entry, that actually some issues were removed on the risk-free margin, but actually an offsetting adjustment was made to insurance company capital. I'm sure if you talk to insurance company executives, they would walk you through it.
Yeah, but we have a regulator saying this is going to cost the public purse, with respect. So I'm not really interested in what insurance companies have to say, because what's important is that the government heeds the concerns of the governor of the Bank of England and the PRA, head of the PRA, who's saying this is going to cost the policyholders.
Well,
do you either? I mean,
I'd go back to the point. You need assurance that there's plenty of capital backing the obligations. Now, I know next to nothing about capital measurement in the insurance sector. I believe, however, that a lot of capital, as measured by the accountants, comes from an assumption called matching adjustment. Keith will know all about this. Maybe that's entirely well-founded, but I think something to focus on, something to possibly to check, is that those are well-founded assumptions rather than assumptions that in adverse circumstances might evaporate before one's eyes. I agree with the bank, with Sam Woods and others, that if these risks crystallised, and we're talking about tail risks, but if they're appreciable, they're a major public policy concern, I think it would be policyholders and maybe the Treasury, if the Treasury had to bail out, and not a wider financial stability issue.
Yep.
But it could turn out to be a wider financial stability issue. If you imagine, I'm not going to conjecture any names, a large insurance provider going under.
Yep.
I mean, AIG was part of the 2008 fiasco.
Yes.
Who knows what the wider consequences might be.
So would you say, just to pursue this further, so would you say that actually, I mean, we've got a difference of view here. Sam Woods has said he's not so concerned about financial stability, but they are concerned. Both the Governor and Sam Woods have both expressed concerns about policyholders and cost to the public purse. What should we expect the cost to the public purse to be to policyholders if this goes south, if we don't act in advance preemptively to make sure we don't end up there? And what's the worst case scenario of a financial stability risk if that comes to pass?
I mean, the hit to the public purse in these, one hopes, extreme adverse circumstances, I mean, either the policyholders or a proportion of them would just have to take the loss. I mean, equitable life is something that comes to mind.
Yeah,
here.
that's what they referred to.
And was mentioned. And that, of course, was not a financial stability issue.
Yeah.
It was a policyholder issue. And so I agree with Sam Woods that such a crisis would probably just take that form. I was simply saying don't exclude the possibility that it could run wider. So I don't feel I'm disagreeing with his evidence on that. And then it would, it's the difference between the value of the promises made to the pensioners and the asset value backing them. But if you had a much more risk-on approach to managing those assets, then there's a chance you're in an unlucky part of the distribution. The equity markets tank or whatever assets, private equity, or it all goes south, while the cost of funding the promises stays high.
So the reforms as being proposed, with the things that are being said about policyholders, is that in the worst case scenario, if it does go wrong, then you have to, there would be the policyholders stand to lose, and would need to be there'd need to be some sort of bailout by taxpayers. Essentially, that's the worst case scenario if this goes south, right?
I mean, when you say there would need to be, I mean, then it would be there would be the pension protection fund
the
up to a point,
fund.
and after that is politics, which
exactly.
But this is at the side of the table. Yeah.
So I suppose what I'm saying is that if we were having these conversations pre-financial crisis, we would, it would be, the responsible thing would be to ask these awkward questions about how we try and mitigate against going down that path that taxpayers, policyholders end up making up for mistakes that may happen when reforms are taking place that have unintended consequences or consequences that can be seen, that have been, there's forewarning here by senior people in the central bank and the insurance regulators telling us that this is of concern. So should the government be heeding those concerns and making sure that there's mitigation now so that we don't even have to go there?
It's quite difficult to, that it should be on the radar screen and that the overall quantum of capital should be held with a significant margin over those long-term liabilities, I think is a given. So you have the opportunity to raise that one of the problems with these insurance contracts is that there's very often a difference between the economic mark when you're matching to a long-term liability, so that you can hold an asset which, from an accounting perspective, is very volatile in the short run, but because that's matched against a 30 or 40-year liability, actually you can look through it and you can hold that.
Sure.
If you force that liquidity shorter, then you're in danger of crystallizing the very event. So actually making sure that the disposition of assets maps with the efficient disposition of liabilities,
sure,
and the accounting and the discount rates are in the appropriate place is very important in this territory, and I think that's a lot of what Solvency II has effectively tried to do.
Yeah, I appreciate what it's trying to do, because we've been looking at this for quite a long time.
Yeah.
But we need a guarantee that our constituents in the long term don't end up, losing out because this hasn't been thought through, or sidelined, or not given the importance that's required. So just to
say we're expecting a letter
sure,
from Sam Woods on this very topic, and
sure,
I don't know if there's anything.
Yes,
could I make one general remark? I believe on this point. One, if you like, official way of trying to look ahead is to run stress tests.
Yes.
My view is that one should look at those. They're very important, but look at them with a very sceptical eye. And going back to banks, the starting point for any stress test is how much capital do they have to begin with before the hypothetical stress. The way central banks run stress tests is to assume that the accounting measures of capital are the truth. When you look at the market values of a number of our banks, and the same would be true even more so in parts of Europe, the price-to-book ratios are a long way below 1 in a number of cases, which is to say that the market value of the banks, as the equity markets are judging it, is lower than the accountant's value. And I've long held the view that we should have parallel stress tests, the official ones on the traditional assumptions, and maybe in an annex, but at least there, something that's run on a market value basis in cases, and they are widespread, where the price-to-book ratio is less than 1. We also saw with LDI that everyone had passed stress tests with flying colours until it actually happened.
Yeah,
Again,
exactly.
Scepticism is healthy.
Yeah, thank you. So I'm going to just wrap up with the questions around culture and ring fencing. You received evidence from the PRA as part of your review that suggested ring fencing had improved its ability to effectively supervise UK banks. Given the changes that are now going to be made, how much more difficult would it be to supervise UK banks without ring fencing? And does the removal of ring fencing pose a risk to financial stability?
First of all, I want to be as clear as I can that the RFPT review did not recommend removing the core of ring fencing. What it actually recommended was the alignment or integration of the ring fencing and resolution regimes, and that any bank, one mechanism for bringing them together was once the Bank of England or the PRA or a collection of the authorities had deemed that a bank was resolvable, and that's an interesting question in itself, it could be released from some of the bureaucracy that comes with the ring fencing regime. it should not lead to a diminution of capital. It shouldn't release a large ring-fence bank from, the supplementary capital that it has on board. It was simply that because the resolution regime and the ring-fencing regime have taken different approaches to what are seen as critical economic functions, it's important, we felt, for efficiency, it's important that those two regimes come together.
So they're going too far beyond what you've recommended. So
we're just basically saying that our analysis was that the ring fencing, the resolution regime, over time would overtake the ring fencing regime, and so we wanted to keep those things intact. In terms of culture, I think that the SMCR regime has done some terrific work, and one of the things we acknowledge in the report was the cultural change that we've seen take place. And as somebody who has actually implemented both SMCR for an insurance company and a slightly more tougher proposition in an asset management company, I think the philosophy and the high-level recommendations behind that are incredibly important. Some of the reporting, some of the bureaucracy that goes with SMCR, I think could be more efficient. I would not
but
like
the
to see
government's
us
going a lot further with respect to Keith, a lot further than what you're proposing. It sounds. So my question is, given where we are, does it pose a risk to financial stability? Yes or no?
I think if it was removed altogether, it would create a risk to financial stability.
Thank you.
With
So
other
John,
incentives.
do you want to answer that question?
Let me try and summarise my view on this. I completely agree that the structural regime, ring fencing, and the resolution regimes, they need to work together. And given that ring fencing was put in place before the way resolution has evolved, I'm sure there's some improvement and alignment. No problem at all with that.
Yeah.
What I would worry about, this language of resolution regimes overtaking ring fencing, that troubles me because I think it's very important to keep both elements, plus other things like capital requirements.
So Keith has said that ring fencing has. Can I just finish this point with respect? There's only one Labour MP today on this. Can I just ask? So Keith has said that it does pose ring fencing. Removing it does pose. Can I just clarify that?
I said
removal of
SMCR.
ring fencing.
No.
Sorry, could you clarify your point?
I apologise. It wasn't ring fencing. I was talking about SMCR.
Would pose
would pose
risk to financial stability.
If it was removed completely.
Okay, so John, did you want to just clarify this point?
I'm going to bring in John now.
I'm just saying one sentence. Removing ring fencing would, in my view, pose a very great risk to financial stability.
But it is your understanding that that is not what's being proposed here, correct?
That is not the immediate proposal, but there is. There was something said in Sir Keith's report and also in the Edinburgh Reforms package announced by the government that while it's worth retaining ring fencing for now, there might come a day when resolution can do the job instead. And I think that's the wrong approach.
Thank you.
John.
Thank you. I want to turn, if I may, to